Everybody. I'm here with another LinkedIn Live. Our co-host Matt Druin has a family emergency, so he won't be able to join us. But I do have our guest Craig McGrouther coming on here in a few minutes. He's just getting the tech sorted on his end, so I figured I would wrap a little bit while we wait for him to get here. Let me pull up his bio for you. Of course, I closed the page. Here he is. All right. Hey, Craig, how are you?
I'm doing well. Can you hear me?
Awesome. I just got to fix my settings too. I screwed up when I took my headphones off for a minute.
Can you making sure the audio sounds okay?
I can hear you good. Yeah, you sound good.
Very good.
Yeah.
Crazy day in the office. We're getting everything ready to go for our event coming up. So lots of moving parts and fun stuff. So
Awesome. Yeah, we'll have to have you tell us a little bit about your event here in a minute. Why don't you
absolutely.
just start by giving the audience a little bit of a background on how you got into real estate, and then how you got into capital raising specifically.
Yeah, absolutely. Well, thank you so much, first, Mark, for having me on. It's a pleasure to connect. So a bit about how I got into real estate. Funny enough, some people grow up wanting to be baseball players. Some people want to be growing up astronauts, a doctor. I grew up wanting to be in real estate. I don't know why, but I always wanted to sell real estate. So I got into the business via selling homes first for 7 years. I was selling residential real estate in the Bay Area, likewise in Phoenix, Arizona. So I was doing it there. And then I kind of saw the writing on the wall in the sense that you kind of become a slave to fees and you're a mercenary for getting the transaction, whether it be 2.5%, 3%, or 2% based upon the seller buyer agent commission that is preset or negotiated depending upon the side that you're on there. And quickly I realized that although it's a great business and there is a compounding nature to it, it's not as compounding as the private equity world side of things and the capital raising side of the world. So ultimately, I elected to uh, switch career paths, if you will, into what I'm in right now, which is working with Lone Star Capital and on the equity side. So fortunately, one of my best friends is Rob Beardsley, and he has authored 2 books and is the founder of the firm that I work with, which is Lone Star Capital. So he was nice enough and crazy enough to hire me to help him with the equity side, and here we are now.
Oh, that's incredible. When did you meet Rob? And were you like longtime friends since you were kids, and you kind of watched him building his business while you were doing the real estate sales, or how
Yeah,
did that
that's a
work?
great question. So I met him. So we had friends, mutual friends. I grew up in Menlo Park, California, and then Rob likewise grew up in Atherton, California. And for those who know the Bay Area, those two cities are adjacent with one another. Just basically, our neighboring cities. They share actually the same public high school, Menlo Atherton High School, where Rob attended. I went to St. Francis High School, so I went to a different high school, and I'm also 29. Rob is 26, so I'm a little bit older. So we had a couple mutual friends, and that was kind of our introduction there. I didn't know him in high school. And then I met him, I want to say, in the tail end of my college career, or knew of him because one of my best friends was best friends with him. So kind of mutual friends there. Met up with him once or twice before moving to Phoenix, Arizona. I want to say 2018. And so funny, for those who know Rob, you're going to laugh at this. He was always wearing a suit and tie back then, as he does now still, and as is our company dress code in our Manhattan office. Of course, we're sitting here in One World Trade Center. That's where we're coming live to you from. So summer of 2020 hit. Obviously, we all know what happened then. The virus was spread throughout, and New York was 100% basically locked down. It was one of the most strict places to be. I was living in Phoenix, so I was living with my roommate at the time, who I was very good friends with, and Rob was as well. And he came out what we thought might be for 3 weeks. He ended up saying for 3 months, and we instantly clicked and kind of repicked up a relationship that we previously had briefly started. And we're talking about real estate every single day. I was, as I mentioned, getting back into the residential side of the world in the Phoenix area, and then he had a portfolio that we didn't know then, but we're would learn later, which was starting to moon, which is Lone Star Capital. Kind of followed it and kind of said, hey, if there's ever a sales position or an equity side of the world, I would love to jump into that. And we kind of spoke about that for 2 years. And then finally, he's like, okay, the time has come. It is ready. And I remember one day, this is kind of funny. This is the story. I was getting beaten up over a $500 fee on a contract. So for those who have bought or sold a home before, or have been in the real estate world from the residential side, there's a box where there's a home warranty in the contract, and the buyer's agent clicked the home warranty. When I went through the offer with my sellers, I clearly and explicitly stated that that was a $500 fee that's going to come out of your pocket. Sure enough, 3 weeks later, what happens? They said, what's this $500 fee on the closing costs? Is that going to come out of your check? I'm like, no, I remember actually that we spoke about that. That's a fee right there associated that you have to pay per the contract. And they, went back and forth on it, like, you know what? Okay, I'm not going to let $500, disrupt a good transaction that we've had. We're smooth here. If this makes you feel whole and you're going to bicker over this much, I'll just give it away and move on. So I was venting with Rob one day on the phone regarding that. And he said, well, it's so funny you should say that. I actually had a $35,000 issue. So immediately, okay, I want that issue, not the $500 issue. So that in conjunction to the fact that I didn't want to be showing property, let's say, call it in 110 to 120 degree weather in a July and August day, which when it gets really hot in Arizona, when you're getting on your knees, crouching down, trying to get a Bluetooth thing to connect, when the lockbox is 150 degrees and it's hot, just felt as if maybe it'd be a good time to get my feet wet in this world, and it all clicked and worked out really well, and here we are now.
Awesome. So how long has it been since you made that transition?
That was about over a year ago at this point.
Okay. And you're loving life now in Manhattan and out of the heat?
Yeah, so I go back and forth between Arizona and New York. So, frankly,
Okay.
since I'm on the equity side, I go to family office meetings and capital events or capital raising events, and meet with folks from, literally San Diego to Rhode Island, and, so basically everyone else in between. So I'm in Texas a lot, obviously looking at portfolio. I was just in New Orleans at a Hunter Thompson Raise Masters event. I was just in Texas looking at some of our properties, and now I'll be in New York for the next couple of months to facilitate our event that we have coming up this week, actually. And then for a couple other events that we have for family offices and just networking generally out here. So I go back and forth, and I'm always on the road.
Yeah. I mean, if you want to dive in and tell us about your event, I'd love to hear more.
Yeah, so our event is really, really cool. It's kind of the best and brightest of our network come together in one room to kind of go through and share ideas and thought leadership and whatnot. We'll have some great speakers, but the premise of our event is not so much the content per se, as much as it is networking and hoping everyone leaves with a viable connection that they can do business with. So that's kind of how our event distinguishes itself. We've always said we don't want to have the biggest event. We're not doing this to make money. We're doing this just to be together, to have the best people that we have in our network all collectively under one roof, if you will. We're hosting it this year, really special. Where our office is, as I said, we have office space in the One World Trade Center. We're going to be using the event space on the 64th floor. So this will be an incredibly high level event with spectacular views of the Statue of Liberty and many other iconic landmarks in New York. So it's definitely an awesome event. And if it's too late this year, we're going to probably have the event same place as well next year. So.
Yeah. Is the event sold out currently, or can people still
Yeah,
make a
people
trip?
can still find tickets. If you want to go to lscsummit.com, you can find it there. And yeah, so.
Very cool. Yeah, backing up for a second, it's unusual that you meet somebody that knew right away that they wanted to get into real estate. Most people I talked to kind of came through it in some other fashion. They were doing another career. They figured out that maybe passive investing was more their style, just because they didn't want to work for that W-2. I'm just curious, how did you know so early that real estate was where you wanted to be?
Yeah, this is really funny. And my mom can attest to this as well. When I was a kid, I was watching sports all the time. So I was always watching ESPN. But the other shows I would watch would be anything like home flipping or business flipping. So I'd always was fascinated by homes, and it just kind of always piqued my interest in the creative side. I do think I have a creative bug in me one way or another, and the outlet to do it I always saw was homes, and it's always appealed to me, design and that aesthetic associated with it. So that's, I think, where it came from, and I always knew that would be my start to it. Did I ever think it would kind of bring me to this direction? Not necessarily, but I'm super grateful for it, and I'm happy to be where I am now currently.
Yeah. So how old were you when you got your real estate license?
Yeah, so right when I graduated from the University of Arizona, I was 21 when I graduated. I got my license, I want to say 4 months later, so I was 22.
Okay. And what did you study at the U of A?
Yeah, so I was an urban and regional development major, which was basically principles and practices of land development, land placement, a lot of logistics and transportation also associated with it. So definitely ties in nicely to real estate, but it's kind of funny. As anyone knows, when you get into the business, things are a little bit different. Obviously, the finance side and economics, and for spreadsheets and stuff, are very important in regards to underwriting and whatnot. But when it comes to practicing and selling and building relationships, there's no real school book or handbook for that. I think you just got to figure that out. For some people, it comes more intuitively, and then some people it just takes time and you practice that skill. But that really is, frankly, what I do now more than anything is just relationship building, making sure that you get back to people and on top of it, and there's no substitute for experience there. It's funny, I think doing what I'm doing now, the route of selling homes and kind of doing the customer service side and hand holding, if you will, and relationship and nurturing, schooled me very nicely for what I'm doing currently. So it's funny, you can't do one without having the other.
Oh, for sure. And when you graduated, were you interested in following that degree and getting into the urban landscape side of your education, or were you like, no, I'm just going to go and do some sales? Or how did that transition work? Because I know that was
I
probably
always knew I was
a
gonna
major
do.
pivoting part.
Yeah, I was always going to do sales. So I just think that
Okay.
with maybe with who I am as a person, I think it's a little bit natural for who I am. And also naturally, I've always wanted to make a lot of money, or at least try
Mhm.
to, or be in a position where I could. And I think one way to kind of secure that and make sure you could do that is sell something expensive, and be in the world of doing something like that. And, homes were an expensive product to sell. So I was doing that. And then similarly, what's more expensive than homes? Okay, well, $100 million real estate portfolio, which we're raising for, that's more expensive. Or bringing the money in for that, buying $20 million buildings, and then doing the capex for that, raising that, and then building that out. So it was just always a progression of sales, but then leading it to where it is now. It's super fun, and it's just been an incredible journey, and I'm excited for what's to come. As I'm sure you're seeing, Mark, and many people in the business, it's kind of crazy what's going on. There's some distress coming up, and there's going to be some really monumental and generationally great buying opportunities coming up that we're really excited to ideally take advantage of. Currently, not that we want anyone to lose money or anyone to be distressed, but inevitably markets do unshake how they do, and we're ready to play offense in a time where a lot of people might be playing defense.
Yeah. Yeah, I just think it's so awesome that you pivoted so early. I've got a young son, he's 11, and I'm trying to coach him when he gets done with high school that maybe we should take a year off and really kind of figure out what it is he wants to do. As I feel like I kind of got pushed by my parents into college. Not that I regret it. I love my degree, but it's completely irrelevant to what I'm doing now. Not that that background hasn't helped me be a better person as far as analytics and doing stuff like that. But I just think it's really cool that you pivoted so quickly. I spent about a decade just grinding it out, doing flips and wholesales and brokering and acting as an agent and building an agent team
So
before I.
you know my pain. You know what it's like on my
Yes.
side, where you're going through, you're running around, you're managing 5 to 10 escrows at a time with a chicken with their head cut off. You're working every day of the week. You're only working with days that end with Y, right?
Right. Exactly.
Yeah.
So yeah, that's really cool. Would you have done things differently? Do you think you would have just jumped right into real estate and skipped college, or do you think no, that's really something that really helped you develop and that you don't regret doing that?
So I look at it this way. There's a couple of schools of thought on this. I would not have changed, I think, anything actually with the path. Um, so when it comes to this question, it's interesting. My circumstance was very fortunate. So I think if you have to accrue and take out potentially student loan debt, that's something where you should consider the alternatives and maybe go to college or figure out a way to maybe subsidize the price via community college or leveraging some sort of scholarship program if available. If it's paid for and your parents and you could provide an education and not, change your retirement or hinder anyone's lifestyle, that's something I would do. But if there's going to be a bunch of debt that's going to be accrued, I think there's so many tools and resources out there now, where you can have experience and get into real estate without a college degree. So on my end, the amount of connections that I made through college, the amount of homes and equity I'll be raising through people in my network from college will be very, very pivotal and will definitely pay for itself, which is nice. But that's not really classroom stuff. That's the extracurriculars. That's from the Greek life community. That's from the associations and people I networked with, as opposed to the university itself. So if you're going to take advantage of it from that angle, it is worth it. Just like anything, what you put in is what you get back. And I put in a lot of time and effort and energy into kind of those outlets. That was useful for me. So I wouldn't do it differently, but I do think that the question is, should you go to college? Should you not? Rob Beardsley, as I said, the founder of Lone Star Capital, the principal, he he went to college for a year and a half and dropped out, and it worked out well for him. Now, granted, he's not the typical college dropout, but I don't think it's necessary anymore to get where you need to go. I think it's all case by case. If one is looking to get into real estate, they could get their license when they turn 18. They could flip, they could wholesale, they could do assignments. And I think that if you work from 18 to 22 and you're going to be in real estate, well, that means you're 4 years ahead in reference to work, which will give you a great experience. You'll have a more fluid understanding of how the world works from a working perspective, as well as a financial perspective, and you will get life experience there for sure. But also, college will give you a different sort of life experience as well. So there's no right or wrong answer. I think it's all circumstantial to what you ultimately want to do and what you're going to make of it and what your intentions are going to be. So I know that's kind of a wishy-washy answer, but my recommendation is, of course, like anything in life, it depends.
Yeah. Yeah. I can't see myself discouraging my kid from going to college, but part of me, when I see what's going on in the economy and we've got such a lack of trades that we're paying out for, carpentry and plumbing, and we can't find skilled labor. There's not enough
Electricians,
people,
you name it.
electricians, everybody. Yeah.
Yeah.
What would you say are some of the biggest challenges you guys are facing today in the capital raising space?
Yeah, well, that's a great question, and I think everyone's experiencing investors that are not as willing to part way with their hard-earned dollars, or they might not have any equity to deploy in capital right now because everyone's tightening up, or even moreover, a lot of people are getting capital called right now. And let's say if you have $50,000 or $100,000 that you want to deploy this year, let's say you're in 4 or 5 syndications. Well, you may need to reinvest that money back into your deals and kind of chase those deals in order to not dilute your equity or to keep a deal alive before turning it over to the bank. So you're kind of potentially chasing good money after bad money, in the sense that you have good money right here that you're putting after bad money over there. But you may want to, meet that capital call to help your friend or, somebody you have a relationship with, someone that you made money with, to protect your investment. So there's been a lot of people that are just scared to invest right now because they know people getting capital called. Maybe they're not necessarily, but they just don't think that it's the right time. And then secondly, there's a good amount of people who need to throw their money back into deals that they're currently invested in order to preserve where they are currently. So those are two kind of tough problems that people are working with. Also, another thing to think about is, where are risk-free rates right now with investments? There's a Vanguard fund where you can get 5.6% money risk-free on your equity. There are bonds that are paying about 4.5%, I believe, risk-free as well. So your yield on our end from a cash on cash investment perspective needs to be that much better than what free money is essentially coming your way, right? So those are some things that we're challenged with right now. And we work with a lot of fund to fund folks. And unfortunately, this is nothing that we want to have happen and nothing they want to have happen. But sometimes people are saying $1 million and are only bringing 500K, which is totally understandable. But who on the sponsor wide level has to make up that difference? It's us, right? So whoever we say yes to or say no to someone else, the biggest thing we're trying to figure right now is, okay, if you are going to raise capital for us, how much do we need to handicap your tranche? So that's the question right now. And then also, a lot of people really like the deals right now because deals are actually getting sexier as we speak, but equity is not as available. So it's funny, when money is easiest to raise, the deals are the worst. When the deals are the best, the money is hardest to raise, and it will never not be that way, unfortunately.
Yeah. And where would you say we are right now? Is it going to get harder? And for how much longer do you think until things are going to change?
I think that the market will slide and decline a bit. I think we are through the slowest phase of lack of velocity for deal flow. I think we're close to where the rates will be at the highest. So once we have some certainty there as to how rates will go, transaction volume will start continuing again. But equity will be very, very stingy. So I think we've got another 24 months at least of capital raising being very difficult. But then through that, things will get better. But I definitely think we're going to see distress in the market for some time coming up. But I think from an equity perspective, we're gonna have probably 2.5 years for sure of money being tough to come by, maybe 3, but the other end of that will be incredible. And then if you are an investor, if you are thinking about putting money into the market and putting it to work, between now and the next 24 months will be the best opportunity window we'll have for the next decade. So think about that. It'll be probably shaky hands giving over the check, but if you can do it, you'll make a lot of money on it should you pick the right winner and work with a firm like us.
Yeah. And how are the numbers looking right now?
So in reference to new acquisitions, I would say that things are really starting to expand on the cap rate side, where we're almost achieving positive, or basically are at neutral leverage, which for those who don't know, neutral leverage is, or positive leverage is when your interest rate is lower than your cap rate. So when your cap rate is higher, that's a great spread and usually is a sign of a really good deal. Or at least a fruitful deal, one that makes sense from a DSCR coverage or DSCR ratio and whatnot. So we're starting to see cap rates expand and cash on cash and yield get better. So deals are actually starting to make sense. And that has happened over the last couple of months. And was speaking with our director of acquisitions today, Brad Oliver, regarding that, as well as Rob, on some due deals that we're chasing down right now. And they're making more sense than any deal has in the last probably 18 months, I would say, which is exciting.
Yeah. Do you guys strictly stick with multifamily?
Yeah, so we are only and exclusively acquiring multifamily assets. So just a bit about what we look to acquire and where we are. So we are Lone Star Capital in the Lone Star State and exclusively in Texas. So we look to buy properties in Dallas, Houston, and San Antonio. So San Antonio is a new market we're looking to emerge in. We've got about $300 million of assets under management currently in Houston. So it's a staple of our portfolio, which we're really bullish on. It's terrible what's going on, of course, in Israel and the Middle East right now. What I think an unintended consequence is going to be is oil pricing is about to get really difficult and challenging. Where is one of the biggest suppliers of oil? Houston, right? So we are, unfortunately, a side product of that will be that market, I think, really thriving during these times coming up. Dallas, we love Dallas. Everyone loves Dallas, but it's very challenging to make the numbers work and feel good about it on the front end, at least right now. San Antonio is kind of the third and wild card in the mix, where we feel as if it has great, really solid incomes, solid tenant profile. It's not crazy like Austin, but it's the third biggest city. I mean, Dallas and Fort Worth. Dallas, Fort Worth is huge, but those are considered different cities. Houston's the biggest city, of course, in Texas. Then it's Fort Worth. Then it's actually San Antonio, then Dallas. But if you combine those two, it's kind of separate. So it's kind of loaded. But Houston ultimately is the third biggest city in Texas, and it's close enough where a property management or in-house team can handle those portfolio or those properties and expand the portfolio there. So we're really excited about those 3 places.
Yeah. Do you guys get involved in the build to rent space at all?
We do not do any BTR. It's definitely something interesting, but we actually haven't done any BTR, and we haven't done any develop. We've exclusively done multifamily value add opportunities. So typically speaking, the Class B, I would say, maybe some A minus. There's actually a property that we're currently raising for. That's an A minus property inside the inner loop. That's a 2008 build property. But I would say C plus to A minus is kind of the range we're in.
Yeah. And what's the unit count on that one that you're raising for?
Yes, so this is a three property portfolio, 666 unit opportunity in Houston, which is really cool. We're using a unique tax abatement program as well on this property. Fortunately, we have a partnership there, which I don't want to get too into the weeds about. But if you want to learn more about that, feel free to reach out to myself, and I can kind of give you the walk down there. But that's a 3 property portfolio, 1994, 1999, 2 garden style properties. That's Beckley and Highland, and then Meritage likewise is also in this, giving diversity for our investors there and spreading the risk across. Of course, we actually, a question we commonly get as well, Mark, is how often, or do you invest or raise for a fund model, or do you do individual properties? So I don't know what you're taking this. I'd be curious to know what your preference is on your side as an investor, as someone who raises capital, as someone who's in the business, of course, what your preference is. But I like the fact that we raise on a deal per deal basis, because you know exactly what you're getting. It's not just the box of chocolate mystery bag that most of these properties are good, but I don't like those, so therefore why would I want to buy that or eat that, right? So we feel as if having this specific underwriting and kind of meeting your investment criteria is a really great solution, as opposed to kind of the variety box that a fund can offer.
Yeah, no, I agree 100%. Are you getting, is that in an opportunity zone, and that's how you're going to get some of these abatements, or?
It's just a relationship with our unit count and kind of our presence in Houston. We have been
Okay.
navigating and working on a relationship for several years, and it's finally came to fruition, and we're able to take advantage of it now, which has been very fruitful timing for us.
So how does that work? That's just kind of like the good old boys club, and you know the right people. You're able
I
to
wouldn't
say,
say I
"Hey."
wouldn't say yeah, I wouldn't say the good old boys, just preserving affordability. It's a mission that we are really,
Mhm,
adamant about, and something that is necessary in this nation. Unfortunately, in one way or another, the wealth gap is creating or is expanding more and more each day. Unfortunately, it's terrible. I feel as if the rich are getting richer and the poor are getting poorer. Unfortunately, and um, markets even like Texas that are affordable are not really as affordable as they used to be anymore. And with that
mhm.
said, this is a great way to preserve affordability while also giving investors a great opportunity to acquire, get a healthy return, and then the city can preserve affordability, so all parties can win in this circumstance.
So you have somebody on your team that works directly with like the city council. You take them your vision and say, "Hey, in order for us to get this to work financially, we need these concessions from you." Is that kind of how that
Something like
works?
that. Yeah, something like that, I would say. It's more a little more nuanced to that, and with that said, Kent is spearheading that on that front. But nevertheless, it's a really cool program, and we're looking to still do market rate deals. But right now, market rate deals with debt and cap rates still pretty compressed. It makes things very challenging. But as I mentioned earlier, it is nice. Things are starting to open up a bit more on cap rate side and whatnot. And when we get positive leverage, the great thing is we have to raise less equity to buy a bigger deal. So we're actually looking
Mhm.
at a deal right now in San Antonio that it's about a $25 million deal. We need to raise about $10 million versus before earlier in this year. I want to say in January, February, if we were going to buy, call it, if we were to raise $10 million, we're probably buying a deal for $15 million just with where leverage was at and cap rates. So it's nice to see that the numbers and ratios shift a bit, if you will, because it's very challenging to raise that much money for a deal in that regard where depreciation is not as much. A lot of investors that we work with love the bonus depreciation. They love the tax benefit of it. They also like leverage, and less leverage is not ideal for a lot of people, and moreover, is not ideal for a lot of people. What we've kind of trained investors to see, and what the market was before, was a lot of instances where if you raise $10 million, you could buy a deal for $40 million. So having those
Mhm.
numbers kind of flip flop on you is definitely something that people need to get used to seeing.
Yeah, for sure. Huge difference. Are you seeing any challenges as far as like your value add when you go to get the labor involved and get these things done on time? Are you having delays, increased holding cost, increased labor and material costs? Is that affecting the pro forma, or are you pretty good at budgeting that up front and keeping things on track?
Yeah, it's a great question. So I think everyone struggled with that during COVID specifically, especially
Mm,
during the middle of that when there was, how many materials just off the coast of Long Beach in California. And the supply chain was all messed up. The good news is that those problems have mostly gone away. And yeah, things are more expensive for sure, but rents kind of went up there. So it's typically speaking, the worst is when everything gets more expensive, but then rents go down and interest rates go up. So
yeah.
we have seen rates go up, but rents have also increasingly gone up with inflation. So it's kind of always a mirroring situation. Even if costs go up, but if inflation goes up and rents go up, it kind of nets one another out. So fortunately, we've had very good operations. We've still been able to turn over units. Costs haven't been too terrible. Naturally, labor is going up, but the one factor that is really making people or making deals really struggle is insurance costs. So if
Yeah.
you're in the Floridas of the world, if you're in the Carolinas, if you're in California, if you're in the coastal markets of Texas, like we are in Houston, insurance has been a big struggle and a kind of an X factor and a tough wild card to kind of handicap the portfolio with.
Yeah. How much is that impacting your bottom line?
It's a ton because a lot of from my understanding, I was kind of looking at a graph from this before, and I was chatting with the principals of our firm, Rob and Kent. We were kind of laughing about this, but insurance is kind of interesting. It goes like this. It goes like this, and then it'll go up. So we're in the cycle that went like this, like a very steep decline, and then it should probably go like this and be a little bit more normal. But that happened recently. So now moving forward, it'll be easier to predict. We also have a master policy specifically for Houston, which is keeping our pricing a little bit more dynamic and economically viable. But
Mhm.
it's really kind of taken some properties just out of the running, especially with compressed caps, with rates high, and with that there, with insurance costs there, excuse me. It's been very challenging. It's been very challenging to get over the hump of a lot of these properties. And right now, we're just really not in the market and wanting to be in the business of pushing the envelope on any acquisitions for obvious reasons.
Yeah. What are you guys doing to source your deals?
Yeah, so we have a great broker relationship. So we have, being that we've got $300 million of assets in Houston and just, about $400 million of properties lifetime in Texas that have been acquired. We have a name for ourselves there. So we have awesome broker relationships throughout the three markets that we're looking to acquire property in. We have people that have sent us deals and gone full cycle with them that know us, like us, trust us, know that it's very unlikely that we're going to retrade them at the 11th hour and kind of make everyone's life a living heck, if you know what I mean.
Mhm.
And then also, execution and performance. We have a good reputation of closing and not tying up deals and walking away. Unfortunately, things happen where that may happen here and there, but more often than not, basically with high level of certainty, we'll be able to perform, have the money come in for the deals, do everything in an effective and orderly manner and such.
Yeah. And what is your strategy for capital raising? Maybe talk a little bit. I don't know if you know the answer to this, but starting as Rob started the company and grew to where he is today, what did that look like from a marketing perspective and like building that trust, building those relationships, and increasing the amount of capital that you're able to raise?
Yeah, that's a great question, and it's the basically the lifeline of any big firm that wants to grow and scale is how much equity can you raise? Because there's kind of the saying, find a deal and the money will come. Well, that's not true. And Rob will tell you that firsthand. Many people tell you that firsthand. I'm sure you've experienced that before. You've had home run deals, but you know when to pitch the deal to maybe, or when you're starting out, it's like, hey, where the heck am I going to find the money for this, right? So it starts everyone. The strategy is friends and family. Know, like, trust. They're more likely to to trust you to get a deal done, and then from there it expanded out. Fortunately, at the firm, Rob writing two books has created a massive lead magnet, especially because they're so specific and niche to the business itself. And then, so we've been, able to get tons of leads there. Another strategy that we have is just going to conferences all the time. That's kind of what my role is now, is to kind of travel to do the stuff that Rob doesn't want to do. Not that he doesn't want to travel, but it's very, very time consumptive on his end to, do multiple things at once, as opposed to myself, where I can kind of, be the Swiss Army knife and kind of go all over the place, fill in that gap, and help Rob do what he does best, which is think, brainstorm, mastermind, and figure out ways to double our revenue while I'll go out and kind of bring home the equity there. But that's one of the methods, or some of the methods is friends and family, start with your network. Then it's, the lead magnet source, LinkedIn, content creation, things of that nature. And then the other great way of being able to source equity is mastermind groups. So we've raised a ton of money through the various channels that we're in, whether it be Hunter Thompson's group or a couple other ones that we're in, has been very, very useful for us to find equity for our offerings.
Yeah. So when you're in those masterminds, you're kind of finding people that are maybe a little bit less experienced, but want to gain that experience through working with your firm and contribute the money that they're able to raise through their friends and family. Is that kind of how that works?
Yeah, so it just depends. There's incredibly sophisticated people that have raised, over $50 million in these groups, and there's some people that have not even raised $50,000 in the group, and there's most people are in between, right?
Mhm.
So it's one of those things where on our end, we'll take a chance on whoever may be. But as far as the groups go, it's they don't want to operate properties. Maybe they love the idea of passive real estate. Maybe they or passive investing, and they love real estate. They love the asset class that we're in. However, they just haven't figured out exactly where they want to do or how they want to handle their equity, or maybe they think they want to be an operator and then realize they don't want to be a property manager and deal with the operations and the asset management side, and they just like connecting people, raising the money, finding the deals from, cherry picking the best opportunities in various markets and going there. So we found that both options are great. Both options are awesome. But the generally speaking, work with people who have got their own, as you said, friends and family network. We work with private family offices. We work with private equity groups, real estate investment trusts, REITs. So we have the institutional equity. with our own, and then our own equity, we call it retail capital, which is our friends and family and private networks, and then fund to fund managers and things of that nature. So we have a pretty diverse and robust capital stack. And then another thing that's been really useful for us has been leveraging 1031 exchanges into our entity and into our syndications. So we
Mhm.
accomplish that via ticks, the tick structure. So having people 1031 exchange not through the DST but through the tick has been really useful for us to pick up equity in large chunks.
Yeah. What is like a minimum that you would require for a 1031 to get into your deal?
A minimum that we would require for a 1031 exchange into our program and into one of our deals is, typically speaking, $1 million. There are
Mhm.
exceptions to that. Maybe there's a smaller deal, or maybe there's a situation where there's just an equity need on our end or their end, or we know the person. But I would say that the number usually is around $1 million that we want to allow to accommodate in.
Yeah. And how are you finding those people? I'd imagine they're few and far between as far as doing $1 million 1031s versus, most. I don't know what the average 1031 is, but I'm sure it's probably not a million, is it?
You
Or maybe
know,
it is.
you'd be,
I don't know.
you'd be surprised. We get some people saying, "Hey, I've got 170K. Can we move it in there?" And unfortunately, that's just way too small of a ticket for us, because our
Yeah.
lenders, it's a nightmare for them. It's a lot more work for them. It's not my issue because I'm not on that side of the team. I let them sort that out. But we've had 1031 exchanges. Believe it or not, we've had a $20 million equity check from a 1031 exchange, and we've gone as small as a 500K check. The way we find that is just, sometimes we have a deal and we cold outreach people, or believe it or not, we go to meetings and there's, an equity need there necessary. Or believe it or not, there's instances where we get people calling us, say, "Hey, I've got a need. I've got a capital situation where this is gonna close. I've got a week to identify left. What do you got?" And we've just been at the
Yeah.
right place at the right time. So, I don't think, for some people, it's not the right fit to be in a syndication, and they'll use that as a last case scenario if they can't find something themselves. And we're happy to take their money as a last case option, if that regard, if there's equity space on our end, and the parameters are then the parameters of their 1031 exchange is in alignment with our profile with debt and equity.
Hmm. Did I hear you say you're doing some cold outreach?
Yeah, there's just sometimes, we find and reach out to bigger private equity groups via email or whatever it may be, that work groups historically like us, where it could be a potential fit.
Okay. Is there somebody on your team that does that specifically, or is that just kind of on a case by case basis? You might need
The
it and
case
have
by
a little.
the case by case, I do kind of all the sales, so my title is director of business development. So I'm the one kind of at this point
Okay.
doing a lot of the relationship building, outreach and calling and whatnot, to kind of share what we're up to and figure out if there's a fit where we could both transact with one another and create a win-win situation.
Yeah. Yeah. I'm curious, as far as like the org chart, how does that look? Do you guys run pretty lean and mean? Do you do subcontracting for certain services, or you pretty much try to do everything in house?
In reference to like how our business is ran,
Yeah.
yeah, so there's about 10 people in the corporate office here in Manhattan. As I said, I float between Arizona and New York. Uh, the two principals are here, so we've got three people on the investor relations side. I would say that's Dasha Beardsley, Rob's sister, who is the director of
Mhm.
investor relations. I'm the director of business development, and then Rob kind of oversees the acquisition side, the debt and equity and whatnot. So that's there, and then a lot of the thought leadership, of course. And then Brad Oliver works directly with Rob on the acquisition side, and then you have Jason and Josh that work under Kent, who is on the property management and asset management side.
Okay. So it's pretty lean and mean. Do you guys take advantage of using any VAs or any kind of
We do.
discounted labor to? Yeah. What does that
Yeah,
look
we,
like?
we yeah, we do that arbitrage play. It's a great question, where we leverage people in the Philippines to help us with the program and processes. It's really important to have people who can help kind of create the content, do some of the admin work to lighten our load. And there's incredible labor that is very economically viable, and is really a wonder for the business, and really helps out. I've got one for my LinkedIn, some of my social media tools that we're leveraging to kind of attract and acquire new investors. And then similarly, Dasha, with all the hats she wears on that end, has one. Rob has one, and then also Kent, the other principal, as I mentioned, has a virtual assistant as well.
Very cool. I don't know if you could answer this, but how would you how would you plan to manage cash flow during different market cycles as we go from one market cycle to another? Um, what does that look like from a business standpoint? Were you guys stacking cash when things were good so you can get you through a little bit of a pause, or are you saying no, we're still making deals and our cash flow is still pretty healthy?
Yeah, we've got very healthy returns on basically all of our properties. There's a couple of them we pause distributions, not that they're in risk of getting capital called or the bank taking the keys and we can't make the payments. But we've got fixed rate debt on most of our deals, which is great. And moving forward, we're going to be doing fixed rate debt deals because we don't need to have the biggest operation in the world. We've never been reaching out to have $100 billion portfolio. What we're really looking to do is have the smoothest business and have the cleanest business and have be able to sleep well at night. And one way we can sleep well at night is knowing that we've got fixed rate debt, that our DSCR is above that 1.25 number, that we've got a nice tarmac, and that we've got a good basis on every single deal where no matter what happens, come hell or high water, that the properties will be just fine. And moving forward too, we're not looking to do crazy risky deals with reputation and stigma issues all over the place where we struggle with many things like neighborhood issues with occupancy issues, and that's when you get in trouble. But if you buy more quality real estate and put fixed rate debt on it, it's very challenging, and aren't too levered, it's very challenging to lose in this business.
Yeah, that's good. Maybe take a step back and talk a little bit about the property management side. I've been building a property management company for the last 15 years. It's one of the more challenging aspects of generating revenue from real estate. How do you find? I assume you guys are working with third party vendors on the property management. Is that something that needs a lot of oversight? Is that something where you're maybe firing somebody and hiring somebody else? Is that or is it once you're at that scale of hundreds of units, the operators in that space on the property management side are pretty good at their job? Or do you have any comments on that?
Yeah, we actually have our own in-house property management team that exclusively
Okay.
works with Lone Star Capital, no third-party assignments. So, to your point, property management, as you know, is a thankless job, probably many times, and not an easy one. It's a constant turning over of labor and whatnot, and it's not easy to retain and keep good talent, as I'm sure you've seen.
Yeah.
So, here we had to take matters in our own hands and make sure that we kind of took care of that on our side and made sure that our properties are getting the white gloves treatment that they need. We don't run this property management firm at all to make money or to turn profit. It's really just for quality control measures and purposes. So we have that there in place to make sure that there's a problem, which real estate is the problem business, that it gets addressed and sorted as quickly and as efficiently as possible. So property management has been a big benefit for us because we have that fully in house and under control.
So when you say in-house, is it a separate entity that just solely works on your stuff? Is if you got a staff of 10 people, that doesn't really leave much room for property management, right?
Yeah, so that's the corporate side on our team, and then we
Mhm.
have our company that we founded that's under our umbrella of Lone Star, which is Radiance Living, which is Texas
Okay.
based. So those are our boots on
Mhm.
the ground.
Okay. That's the property management firm.
Yes.
Okay. And then how did you build that model? Or maybe this is not in your lane, but
Yeah.
did you just go into the marketplace and say, okay, these are what our competitors are charging. This is kind of how our competitors operate. We need to
Yeah.
build something better, or
Yeah, we were really transparent with the people when we didn't have the property management firm. So we actually started it really early in our life cycle. Lone Star Capital is only 5 years old. It was founded in 2018, and our property management
Mhm.
firm was created 3 years after in 2021. And we'd
Mhm.
met Aaron Petrie, the executive vice president of Radiance Living, who runs it, lives in Houston, and takes care of that. And we found him from the other group we were with before. He's got about 20 years of real estate experience on the property management side. So he's a
Mhm.
pro. He knows everything about everything with regards to Houston and such, and it's just a total asset. I'm the salesperson, but he's really the salesperson. Everyone loves him when they meet him, when he tours them through units and stuff. They know he knows his stuff like cold, which is awesome for our end, of course, naturally. So, with that said, he's been a total asset, and we found him actually via the old group we were with before. So we found him from the old property. We're very transparent, saying, "Hey, we're looking to build our own team out. We wanted to set the precedent and didn't want to have anyone feel negative about that." And we kind of took him from there, and we haven't looked back since. And it's been a very, very productive relationship for all parties.
Awesome. What do the fee structures look like if you know for these larger multifamilies? Are you seeing that you've got to discount pretty significantly to compete? or is it up to you because your investors trust you and they're not really going to get into the weeds on, hey, my management company is charging me, 6% instead of 4% or something like that?
Yeah, so we charge just, boilerplate. We have a 2% acquisition fee. We've got a 3% property management fee, and then a 2% asset management fee. So that's boilerplate, that's standard in the institutional space. We couldn't get away with, robbing people, if you will, in reference to fees and such. It's just not market or competitive otherwise. So
Mhm.
that's how we stand in structure in reference to that.
Okay. Yeah, that makes a lot of sense. Very cool. So I don't know. You have any other insights that you want to get? We're getting close to the top of the hour at 2:45.
Yeah.
Or anywhere
No.
you want to take the conversation?
Yeah, and I just say to anyone who's thinking about investing, or anyone who's been sitting on the sidelines who is thinking about doing that or is feeling doom and gloom, there's going to be incredible times to invest here coming up. Nothing stays, lasts forever. Whether when we were all drunk on interest rates when they got super low, or when rates are really high right now, it's always a good time to buy real estate if you got a good basis and you have a good out long-term mindset on the property that you're looking to acquire in. And then biggest thing we're looking to do is just have a smooth operation where everyone can sleep well at night, and that's kind of what we're looking to do. So if that's kind of something that you're looking for to raise capital for, to be involved with, I think we're the people for you.
Yeah. And I don't know, we could probably jump into thought leadership a little bit. We kind of grazed by it. What do you guys think is the most important part of your thought leadership platform? Is it like the conference that you do, or is it kind of like a mix of different styles?
It's a great question. I think the biggest thing for thought leadership is just transparency and being honest and authentic and not creating something fake, and puffed up just to look good. So, Rob is a very, and we're both very honest people, but also we're not trying to be someone that we're not. So what we are doing is true to our core, and we know that what we're doing from a thought leadership perspective is good for the brand and for the business of real estate. So just educating people, and sharing the important things and making sure that investors are educated and aware and are careful of the pitfalls that can come in this business. Unfortunately, you can make a boatload of money in real estate. You can also lose a boatload of money in real estate. So we hope to aim to protect people in that regard and kind of serve them in a sense. And I think one way we can do that and have done that is via all the avenues and kind of the content we've created. We've got a podcast where we kind of go through what's going on currently, which is always fun to do. We've got our conference where you kind of see the best and brightest from our network. And then we're always posting articles and creating articles, posting facts and interesting things on LinkedIn as well.
Nice. And who's carving out the time to do all that?
We have very, very awesome teams and assistants to help with that. So we've
Yeah.
got leveraging some of our virtual assistants, then also podcasts. That's on my end. So I got to think of the fun topics to do every single week. They're usually current, or we're talking about certain things that I think are important for investors to know. So it's always a different world. That we could get crazy breaking news one day and have to talk about it and go through it. So it's always different. There's always a variance in that regard, but there's always something to talk about in the real estate world, especially right now.
Yeah. Do you try to stay non-political in your marketing efforts and your thought leadership? I'm
Yeah,
in
we don't.
I'm in a very
Yeah,
liberal state, so like I keep my mouth shut when it comes to politics. I don't want to offend anybody with my opinions of what's going on. So I was curious, do you kind of
yeah,
keep that
no,
out, or you say no? I'm just
for
going to go
sure.
for it and let
We
everybody know what I think.
Rob and myself have never cursed on our podcast. We've never talked about anything really in that regard at all. The biggest thing we think about is, hey, we don't really have control one way or another about if things are on left, right, green, blue, red, purple
Hmm.
politically, right? The
Yeah,
bottom thing, the one thing to worry about is how can we profit off it? How can our investors profit on it? And what's the angle we're going to take on it? So that's kind of how we look at it. There are things that are going to change. We will mention them, talk about it, and maybe point out one way or another without getting emotional why we think it's a good or better idea, what the potential ramifications will be, but it's never too speculative or getting into the weeds in regards to something we like or don't like.
yeah. What's the typical life cycle on one of your deals? Are you like in the 5 to 7 year?
I mean, right now
Is
we're
that
probably looking at
mhm.
4 to 7 years, depending upon what's going on. But typically, I'd like to say 3 to 6 years, depending upon the opportunity. 3 to 5, 3 to 5, three to
Okay?
six.
So how many have you guys brought full circle?
So we have 13 properties currently under management, and we've gone full
Mhm.
cycle on 2 properties with a net IRR of 30%.
Oh, it's incredible.
Yeah.
Very
Well, the
cool.
market helped us out. Now the game's on hard mode. So yes, it
Yeah.
is you still have to execute. You still have to have the nuts to go out and buy the property, to execute, to put the business plan
Yeah.
together, and to do what you're gonna say. But now, the game's on hard mode, and, we look forward to earning our stripes and, rising above and making it happen.
Yeah. What do you think the IRRs are gonna look like, on these ones that are coming full cycle and then on the ones that you're underwriting currently?
Well, the ones we're not gonna exit anything for a while, but those could be 10 to 12%, which is
Mhm.
not bad by any means at all. It's beating, the stock market, and, that is investment alpha. But
Mhm.
naturally, with where we bought them, it might be challenging to hit, 15 to 20. I think what's coming up is gonna be somewhere between 15 to 30, to be honest.
Okay. So are you expecting to see, after this, maybe slight decline in prices that we're going to have another bump in prices? That's kind of what I'm thinking based on inflation, really, and all the money that's been
It's
printed.
it's the yin and the yang. It's the cause and effect. Fundamentals and properties are still really good.
Hmm.
Collections have been really good, so multifamily is still very valuable. It's undersupplied and it's very expensive to recreate. So I'm anticipating that prices will rebound at some point. When, I don't know, but we've got to flush out a lot of the silly money that was thrown around, and the bad debt and bad, mismanagement and bad discipline of a lot of sponsors and operators who bought properties where they paid way too much for them.
Yeah. So have you expanded your cycle time for the ones you have under management currently? Were you originally anticipating like a 3 to 5 year, and now it's become like a 5 to 7, or
Yeah,
what
I
does
would
that
I
look
would
like?
say that. Yeah, I mean, we're stabilizing everything. We've got agency debt locked in at good numbers with positive leverage, where we're hitting the payments and able to distribute 4 to 7%, depending upon where they're at in their life cycle, which is great.
Hmm.
So those are going to be delayed ever so slightly. We'll probably unload everything we bought this year, everything else in our portfolio currently, probably around the same year. So there'll be a lot of selling and loans our capital in, about $500 million or so, probably I would say in 2027. But until then, we're probably not going to be exiting anything, and then everything we buy in the next couple of years, we'll probably be selling a ton. As I said, 2027 to 2030, we'll probably be selling
Do you,
billions of dollars worth of real estate.
do you think there's a potential for a lot of other people that are in the same boat as you that are getting ready to unload stuff during that time frame, that it's kind of built up this excess of product, and maybe that will cause a little um, more pressure on the market as far as pricing?
I don't think it'll be forced down, but unfortunately, not everyone's incredibly well positioned. So some groups will for sure, but there'll be normal velocity again. Finally, I mean, what we've experienced this last year has not been normal velocity.
Yeah. Yeah. But even if we have normal velocity, we're going to have increased inventory. So wouldn't that affect?
Not necessarily, I don't think, but it is tough to say. If we do have a situation in which there's a lot of inventory. I mean, there was a lot of inventory before, but if it moves quickly, it's fine. It's when properties don't move, it's when it's an issue, and then it stacks up. Like right now, there's a lot of properties that can't get offers and can't move just because the sellers and buyers are too far apart. But if there's not a
Yeah.
huge bid ask spread, then there will be fluidity in the market
Yeah. There's a lot of cash waiting to get back in.
for sure.
Yeah. That makes sense. Cool. Do you have any final thoughts before we wrap it up?
No, I really appreciate your time. I appreciate you having me, and thank you so much for quickly getting me on the show. I appreciate it. It was good timing.
Yeah. Yeah. It was great timing. And I look forward to meeting you in person. Maybe I can come down. You guys are in New York for the event, right?
Yes,
Yeah, that's right. You said at One World Trade
yes, sir.
recently. Awesome. Cool. And that's when is that again?
That is
Next
this
weekend?
week coming up, October 16th and 17th.
October and 16 and 17. All right, perfect. Well, maybe I'll see you there.
Absolutely. Thank you for your time today.
Yeah, thanks, Craig. We'll see you soon.
Have a good one.